Incomes from annuities have been in the doldrums for the last 10 years and are still at historically low levels, writes pensions expert Billy Burrows of financial advisor Better Retirement. Annuities used to be incredibly popular. After all, if you don't have a final salary pension, they are the only retirement products that guarantee an income for life, with no risk of running out of money. They are a type of insurance policy that converts a pension pot into a series of regular payments for the rest of your, and possibly your partner's, life. In fact, until just 4 years ago, most people purchased an annuity when they retired, and only those with larger pension funds opted for pension drawdown, which gives you freedom to decide how much income to take and where your pension pot is invested. However, during former Chancellor George Osborne's 2014 budget, everything changed when he announced no one will have to buy an annuity. At this point, pension freedoms were born, and for the first time most people could choose whether to take out an annuity or not. Why rates have been so low? When a saver buys an annuity from an insurance company, they hand over their pension pot, and the insurance company invests it cautiously to make sure that it can afford to pay the saver regular payments for as long as they live. These are the types of investments that the insurance companies choose to buy. However, the rates that these safe types of debt pay out have been very low in recent years. The trend dates back to the 2007 credit crunch, when the Bank of England started printing money, called quantitative easing, and used it to buy these very same types of investment. As the bank bought more, the yields paid dropped, because with a higher number of buyers looking to buy the same debt, the amount of interest needed to entice them dropped. So as the yields on these investments go down, annuity rates will go down and vice versa. Today, a £100,000 joint life annuity for a couple aged 65 and 60 and reducing to 2/3 on the death of the first annuitant would pay a guaranteed level income of £4,532 before tax. Four years ago, in January 2014, the same annuity would have paid £785 per annum, more at £5,317. Thirdly, there are now only about half a dozen annuity providers offering competitive annuities, and the lack of competition has kept annuity rates low. So, the million-dollar question for the annuity market is, will yields start to rise and annuity rates get better? It is too early to predict significant increases in yields, but there are some signs that the tide may be about to change. For instance, inflation is on the increase and the global economy is steaming ahead better than expected. This means the Bank of England may increase the bank rate later in the year to prevent the economy overheating and to keep inflation below the 2% target. The fate of annuities may be linked to the outcome of the Brexit negotiations.I If there is a good Brexit outcome and the economy remains steady, long-term interest rates and annuities should nudge upwards. However, if there is a bad Brexit and the UK economy dips into recession, it will probably be bad news for annuities. The table below shows how annuity rates and gilt yields moved in parallel over the last 5 years, and how the low point for annuities and yields was immediately after the 2016 Brexit referendum. In order for annuity rates to return to the higher levels seen in 2014, the yield on the benchmark 15-year gilt will need to increase from its current level of 1.75% to about 3.5%. It will take some time for these yields to double, if it ever happens, so there is little expectation of significant increases in annuity rates soon, but hopefully the trend will be upwards. However, if the UK stock market was to come off the boil and equity prices fell, this might cause some people in drawdown to reassess their attitude to risk and start moving from higher-risk drawdown plans into much safer annuities. Despite low annuity rates, the lack of flexibility, and their poor reputation, annuities could start to become more popular if the rates increased at the same time as the returns for drawdown plans start to fall. Billy Burrows is Retirement Director at financial advisor Better Retirement and runs annuity and drawdown website www. williamburrows.co.uk